Good afternoon, everybody. Welcome to your Thursday edition of the Trader Merlin Show. It is a fun day today. Sorry for the late start. I was over here just chatting away with Bill. We were getting deep into some hot topics. And all of a sudden, look at the clock and say, wait, we're late. So, well, sorry about that one. But anyway, we got a good show to talk about today. There's a ton of stuff going on with regards to interest rates, central banks, that type of stuff. And, we covered some of that briefly yesterday, at least the comments and statements from Jerome Powell, what may be coming down the pipeline and his thoughts on where they should be. And I thought, I understand some of it, but nobody that I know understands it as much as my guest today, who is joining us from the East Coast. We're going to do a little bond market update here with Mr. Bill Addiss. How you doing, Bill?
Good afternoon, Merlin and everybody. How you doing?
We're great. I'm glad you came on.
The problems of the world before this program interrupted.
Yeah, we were fixing everything over there. Maybe we'll continue that discussion as we progress. How you been? Anything new going on in your world?
It's I wish I could say it was more exciting, but let's face it, like everybody else in terms of the market, we're all waiting for what data determinant really means. This week was a bit of a snore in the bond market, and the Fed was no surprises other than the tapering, which we'll discuss. So it was a rather boring week, so I've been getting a lot of housework done.
Good. Housework is always a good thing. Are you, I know we'll talk about your Canary in a Coal Mine class, but are you going to be traveling? Are you teaching some online classes for everybody?
Yeah, the summer months really pick up for me. So starting, this is the lull before the storm. Starting in June, I work with most of the major banks and dealer firms and the Fed, and they hire this army of young students right out of college called associate analysts, and we get to spend the summer training them. So I think the number is going to be up to about 2,500 new hirees that I'm going to be working with starting in June. So that's a lot of June, July, and August are living on the road.
Wow, that's a lot of new, fresh meat for the financial grinder.
Yes, it is, to say the least. Some might question whether we need that many baby bankers, but that's not for me to decide.
Hey, as long as there's people that are willing to jump into this arena and get in the financial world, good for them. Good for them.
Fresh blood, fresh meat.
Fresh blood. Yes, exactly. So let's talk about Jerome Powell yesterday. No surprise, he kept things right where they are at 4.5%. What were some of the takeaways for you? Or let me just say, were there any takeaways for you? Was there any aha moments? Did he change any words for you?
No, the adjectives seemed pretty well. What I did like, though, to hear, and I think the equity markets like to hear it, was his commitment to the economy over inflation. That if push came to shove, even with high inflation numbers or, inflation not within where they want to see it, which it still isn't, they're going to be most responsive to the economy. And I think, the equity market certainly took a sigh of relief from that. But what we're perhaps tiptoeing with, and this was part of the conversation you and I were having, is, you set up the scenario right. We could be looking at that dreaded stagflation that we've been kicking around for a couple of years.
Right.
And I think that's what people are worried about. Is the Fed going to get into that quandary that what's going to be good for one mandate is going to be dramatically bad for the other? So you're kind of damned if you do and damned if you don't in terms of changing rates.
Right. Well, at this moment in time, if you take those three variables of stagflation, you have only one of them, at least from a current statistical data, looks bad. It's not unemployment, because unemployment's 4.1%. That looks fine. Right. It's not accelerating. Although I think everyone would agree that given all the layoffs and not just from government layoffs, but corporate layoffs, that should start to rise as we go forward, but It hasn't happened. That's all expectation. Second piece is going to be the inflation side of things. And I'm in that camp that I think this tariff war is going to start to create higher inflation rates. And lo and behold, our core our CPI numbers and PPI numbers looked great. Inflation is not even existent on PPI. Like, wow, fantastic. So our third variable is GDP. Now, of course, with stagflation, you're looking at GDP declining, right? A continuous decline in GDP. And some of the central banks are saying, no, we're good. We've got growth. And then you have Atlanta saying negative 2.8% GDP. I mean, let's get your act together. That's the only one that I think has at least bigger targets for decline. Everything else seems to be okay. So in my opinion, the stagflation argument is not there yet.
Oh, I'm with you 100%. It's very premature, and there's a number of different scenarios that would have to play out. But, the bottom line is the Fed's got these dual mandates that don't always work nicely in cohesion with each other, and they have to pick and choose. And I think they did a great job after the pandemic. I'm still of the camp the Fed's entitled to take a bow for the way they handled the pandemic. But they brought rates down, they raised rates up. We had the inverted yield curve for 18 months, and we never got the dreaded recession that I and everybody else was looking for.
Yeah.
So I think the Fed is really, we have to give them credit. They've done a very skillful job of handling, what is an unprecedented economic scenario that we've been through. So I think they're entitled to a bow. I really do.
All right, you have downgraded. Let me just say, you have downgraded because you said earlier a victory lap. So we've gone from a full take and wave on all the crowd to just bow because you don't have enough time to do the full victory lap. Apparently, I'm with you. Sure, you did fine, you did okay, but I don't think we're out of the woods yet. And this is the beauty of financial markets. It's all about opinions and reacting to what goes on in the markets.
But how many cycles do we have to go through before we can look back at the pandemic and say, yeah, they did it?
Yeah, true. At what point do they get that final nod?
Yeah, right, exactly. So, but I will admit, when you said that, I did get the bristles and hair on the back of my neck stand up when I actually heard Powell use the word transitionary when talking about it's like that word got you in trouble once. You're really going to go back to the well on that?
Transitory was not a term that you want to that one should be just officially retired at the FOMC desk. Okay, guys, that word we cannot use again.
Exactly. I'm surprised the press room wasn't chuckling when he uttered that word.
They did. I thought they did. I thought I actually did hear chuckling.
Okay.
And I think he kind of smiled. There was one comment that he made, and I think it was about that, where he kind of smiled at one of the reporters' questions. I think it was pertaining to that one. That's pretty good. Real quick, Margaret says, can the Fed change its mandates? They got dual mandates. Who sets those?
Oh, that's a good question. How's this for trivia? Those mandates were set by Congress, and I want to say 1968 with the Humphrey-Hawkins Act.
Wow.
Because Congress was so concerned that the Fed was not accountable to them in any way. The Fed we always talk about as a private corporation. They do what they've got their own thing going on, and Congress really didn't like that autonomy. So that's when Congress passed that legislation, Humphrey-Hawkins, which gave Fed these two new mandates, which is stable prices and, full employment. As every economist likes to point out in their infinite wisdom, Congress gave the Fed mandates that at the extremes are mutually exclusive. You can't have both.
Right. It's that nice balance.
Yeah, and hence the problem that we're presented with now.
Well,
Congress would have to change it. For Margaret's question, Congress would have to change it.
So here we are, 57 years later after Humphrey-Hawkins. And, that dual mandate, which, I think it makes it easy, right? You can just focus on these two things. I think most of us, maybe I take a step back. I know a lot of people who struggle in life because they're focusing on so many things, and they just whittled down a little bit, they'd probably be much more successful. With two mandates, do you think that there should be some things added to this? I know this is a curveball question out of nowhere, but you work with the Fed quite a bit. You get to do some training for them. Do you think that there might be something that should be added or maybe taken away from those responsibilities from that mandate?
That's a great question. I believe the mandates are totally political. Because the Fed is responsible for monetary policy here in the U.S. That's one of the three foundations that they were created with back in the 1930s. So this goes back to their creation. They are responsible for monetary policy. And the mandates that Congress gave them 40 years later, 50 years later, was simply kind of a formalizing of what they were already doing.
Mm-hmm.
And I really believe it was only done for the purpose of our elected officials to be able to call Powell in front of them twice a year so that they can beat him up. The only real practical implementation of these dual mandates is twice a year he has to get in front of Congress and C-SPAN and answer their questions. Otherwise, he wouldn't even have to do that.
Yeah,
I really think it was politically motivated, that as a functionality, the Fed would be operating with those official mandates or not.
But we've progressed significantly in the 50 plus years that they've had that dual mandate, and I don't know if there's a right or wrong answer. I was just curious because it seems like over time, maybe we do need to change some of the focus of what the Fed does. Maybe it's now a triple mandate. Now let's go back to the stagflation argument, right? Well, we need stable pricing and we need full employment, so you got jobs and inflation. And we need economic growth. Let's add GDP in there. So now they can balance all three of those. And be an act of Congress to change it. And, I don't think it's going to change, but I'm just curious.
Yeah, no, I see the point, and I'm not disagreeing. I just think from a functional point of view, they're operating with that perspective anyway. It's not like the Fed is saying, gee, we're not going to look at GDP because it's not in our mandates.
Right.
So I think from a purely functional point of view, they're operating with or without those mandates, because that is the essence of monetary policy. That's all that they did. They formalized the bare essence of what the goal is of monetary policy.
Mm-hmm. You and I have talked a lot about the money that has been printed. Certainly going back into when COVID hit, we went from $4 trillion worth of M1 money supply up to $21 trillion in a very short window of time. And they're, trying to remove some of that money from circulation. And those numbers just change here. So talk a little bit about the tapering effect that just was announced at the meeting on Wednesday.
Yeah, so this is for those in the audience who aren't, I try to make this understandable without oversimplifying. And this is one that people have a hard time getting their head around because it really is so simple. Our Fed creates and destroys money at will. That's their job. It's not the central bank. The central bank, the Fed Treasury.
Yeah.
The government has nothing to do with the creation of money. It's the responsibility of the Fed. And during the pandemic, they flooded the U.S. economy with liquidity, with cash. I mean, we created and printed up. I shouldn't use the word printed, but I did that intentionally to create a visualization. But we created over $4.5 trillion of new cash in 6 months. We threw more new cash into the economy during the 6 months of the pandemic than the entire Great Recession of 2008 through 2013, when they did 3 rounds of quantitative easing. Yeah. This last pandemic, it was like QE on steroids. And as a result, exactly as you said, M1, the amount of cash in circulation, went through a 500% increase during the pandemic. So what the Fed decided 2 years ago is, okay, we know that all this cash will cause inflation. They needed to do it because they were worried about the economy, not the inflation. But then when they had the chance to turn to inflation, their answer was to start destroying that money.
Right.
And that's what tapering is all about. So they started with $120 billion a month. They brought it down after a year to 90 billion, then 65. And the announcement that was really the news of this last FOMC meeting is on their treasury portfolio, they're only going to destroy about 5 billion a month. I mean, a huge dramatic increase. I mean, our Fed has gone from owning $9 trillion in treasuries down to only $7 trillion. They've greatly reduced their balance sheet in the last 2.5 years, but they're lessening that rate of reduction. And that concerns me a little bit because, we still have boatloads of cash in the economy.
Yeah.
We're still swimming in cash. So to me, it seems a little bit premature. I also have to point out, and this is where if I get nerdy, cut me off. Our Fed, in buying all these treasuries during the quantitative easing, they also have amassed a huge mortgage portfolio. I mean, our Fed is the single largest holder of mortgage-backed bonds.
That makes no sense to me. I don't get it.
Exactly. I mean, I understand. They started doing this in 2008, back when they first instituted quantitative easing. It made sense that the Fed could use some of that money to buy those bad mortgages that were creating the problems for that recession. I mean, that was a mortgage-related recession.
Yeah.
So for the Fed to step in and say, look, we'll take some of that risk, I think was laudatory. I'm glad they did that. But in the most recent scenario, there was no mortgage crisis. There's been no problems with mortgage liquidity. And yet here's the Fed continuing to be a big buyer. And in fact, on the tapering side, whereas they've cut their treasury money, they're going to destroy less. On the mortgage side, they're maintaining their same commitment. I mean, the Fed is basically propping up the mortgage market.
Yeah, I've got two charts here. Let me share this with the viewers because this is IYR. This is the real estate ETF, or one of the real estate ETFs. And when they really started doing that buying of mortgage-backed securities, they were loading the boat back here, 2009, 2010,
right.
And that makes sense. I think we'd all agree. Okay, fine, put a backstop on that because this could just absolutely implode and crush markets even further. But look at this chart. I mean, I know the people that listen to the podcast can't see it, but IYR, which is an ETF that represents real estate, was, let's say, at $21 back in February of 2009. We're currently at $95. And, I think by the time we got to 2013, 12, 13, 14, they should have said, okay, we've backstopped it. It's looking good now. We don't need to worry about it anymore. But yet we're still going. And, I question this because I think that it creates an artificial... I don't know. It's like an artificial stimulus that doesn't need to be there for the housing market. And for the life of me, I don't know what the ultimate outcome is. From your perspective, what do you think will happen if all of a sudden the Fed finally says, okay, we're not buying mortgage-backed securities anymore. We're going to unwind this portfolio. What happens then?
We might lose some participants in the market, firms that are just living off that business. But we've got overcapacity in the mortgage industry here in the U.S. You can pick up a phone and get 4 mortgage quotes in 5 seconds, or go to the internet. I'm sorry, I dated myself there. There's no shortage of mortgage availability now. But I would point out 2 things. Is number one, as a background, I have to point out to the group. Remember, the banks own the Fed, right? The Fed is a corporation. And the shares of the Fed are owned by the banks.
Right.
So they literally supervise their owners. And many people see that as inherent conflict of interest. I'm not usually of that camp. But I think the fact that the Fed is being so accommodative to the mortgage industry right now is a result of the Fed being owned by the banks that are issuing those mortgages.
Yeah.
There is an inherent conflict of interest, but there's even a bigger one, and we hadn't talked about this, but to throw out, we're just talking about what the Fed did under QE, that they bought all these mortgages. Yep. I would also point out the Fed still owns Fannie Mae and Freddie Mac.
Right,
which are the 2 largest.
Andres just says let's privatize Fannie Mae and Freddie Mac.
Exactly. The government's owned them since 2009. So that's a huge mortgage portfolio. Again, the government is bailing out the mortgage industry. Starting with Steve Mnuchin under the first Trump administration, every year we've been expecting the government to sell off Fannie and Freddie. Now, merge them together. There's a redundancy there, and sell it off. And, we're still waiting 16 years later. So why the government and the Fed continues to support the mortgage industry and get away with it, it just amazes me.
Yeah, I'm with you. Great question from Margaret. She says, is the housing market really that important for the Fed to purchase them? No, but, back in 2009, I think it was. Because if you saw
exactly.
an even far worse foreclosure situation, it's a complete loss of capital, of equity, and therefore the recovery process would have been much longer. So I think at that point, that made sense. But, once you're back on your feet, Bill and I were talking before the show, for me, it's kind of like saying, you were in the hospital and you were really ill and you had all these surgeries and you're on morphine, but now you're healthy. You're 100% healed. You're running track again. You're doing all these things you did before your surgeries when you had that morphine, and you still have a morphine drip tapped in your arm. And a matter of fact, they're putting even more morphine in you. I mean, it makes absolutely no sense in my mind, and I think that could potentially at some point come home to roost. I just don't know what the damage is going to be looking like.
Yeah, and honestly, nobody's had a real good look at just how bad the Fannie and Freddie portfolio is.
Yeah.
Maybe that's the real issue here, is nobody's willing to actually bite the bullet given the amount of losses there. The government stepped in because they made the bondholders whole, but they took such huge expenses, they had to come in and take them over. So it could be just a function of just how rotten that portfolio is.
It could be. Well, we'll have Doge go check it out. We'll get Doge in there.
I would put that at the top of the list. That to me is more important than going to Fort Knox and looking at the gold. It
seems like there's a pretty big list of things that they're going after at this point. I want to also share this chart. So this is the chart that Bill was talking about. In February of 2020, you guys can see on the screen here, we had $3.979 trillion worth of M1 money supply. That's actual physical dollars and savings circulation. By June, that's the window of time he's talking about, we went from 4 trillion up to 16.5 trillion. By the time we got to May of 2022, so 2 years in, we had increased all the way up to roughly $21 trillion worth of M1 money supply. So again, I always make this point because so many people like to throw shade at Biden or Trump and say, this president caused this. This is the chart that caused it. This is your inflation booster. And you can see that they did a tapering piece. This is Bill probably saying that they celebrated their victory lap. Well, they went from about 21 trillion on the of M1 money supply, and they brought it back down to 18. So we dropped it 3 trillion, but notice it's cooking back up again. It's moving back to the upside.
What happens at the end of that chart? Yeah, look at that little fish hook that's developing at the end there. That's concerning, isn't it?
It is. I'll do the 10 years. And so it was nice. It was like, okay, here we go. We're doing what we're supposed to do. Get rid of that money, and boom, it started to pop back up. So.
And they are now stopping discontinuing most of the tapering. See, again, there's still so much room to go to work yet, as that chart is showing.
Yeah.
It just seems like they are very prematurely ending the tapering. If in fact, and on top of it, I still have to say we never hit the inflation goals. We keep, we keep forgetting that. So without hitting the inflation goals, why are we discontinuing the tapering if you can still, as that chart so well shows, got all this cash out there in the system? Doesn't make any sense to me.
Yeah. Oh,
But you
well.
didn't ask my opinion.
Yeah, well, I'm always asking your opinion. I love your opinions on this. All right, so we talked about the mortgage-backed securities. They're keeping that at $35 billion. We dropped from $25 billion to $5 billion on just normal securities. Did you see the image I sent you? I sent you an email with a graphic on it. Did you see that coming up?
Comparing Tether's ownership of treasuries.
I thought
to
that was
a lot
interesting.
It is. Now, it is also a function to point out that a lot of these countries, just aren't really buying U.S. treasuries.
Right.
So you're in a group that, that you got the big elephants there, obviously.
Yeah, I'll read it through so for the podcast you can see it. But this is something that came up because, one of the things that Trump talked about in his presentation to the Digital Asset Forum today in New York was stablecoin regulation. And I've made it a point that I think that this is a win-win. And Bill, this is something that probably, for you, I think is really important. One of the big concerns is, you got to create a buyer for treasuries, whether they're shorter term, longer term. You need buyers out there for those projects or for those bonds. And you look at this chart here, in 2024, it shows like the largest buyers of treasuries. And you can see China and Japan are leading the decline. These used to be the biggest buyers. And here they are, the biggest unloaders of bonds in Brazil, Ireland, India, all negative. And then you have, countries like Germany, Norway, Mexico, all jumping on this one. Canada was a net, increase, looks to be roughly about $30 billion. But the reason I put Tether on here is because Tether is a stable coin. And I made the point that microphone, oh, great. My microphone just died on me. Oh, there we go. The stablecoin regulation is going to have a couple different pieces to it. And I think one of them is they have to be cash backed, meaning there must be actual cash in backing up these stable coins, and then bonds, whether those are short-term maturity treasuries or something like that. To me, that is really, really important here because that will kind of steer money back into buying government bonds. So you're creating a buyer by making these, and you've now created demand. And if you set the rules, you got a permanent buyer. I think your microphone disappeared. Hold on a second. Can you guys hear Bill? For some reason, his mic is not popping, and I'm not sure why that happened. You should be able to hear and see Bill. For some reason, your microphone is not on. Well, that was weird. Something clicked, and then all of a sudden, there was nothing left there. So let me try to re-establish our connection here. I'm not sure. No, it's something to do on my end. It was weird. Everything was fine, and then all of a sudden it zipped out. So let me see if I can. Let's see if I can get this. Just bear with me just a second, guys. I could see that his microphones weren't popping, and we will try to get that Chrome on there. Hit OK. Go ahead and talk for me, Bill. No, Bill. No, Bill. Dab nabbit. Do me a favor, Bill. Let's log out and then try to log back in. I'm going to see if I can open up the room again. It'll take me just a second to get to that room, but I apologize for everybody. But let me end this and start all over again. Something must have happened here. And hold up. Hey. We'll get him back on, I promise. Because it was some good talk coming in there. I was really interested in what was happening. Let's go All right, give me 2 seconds and I'll have it up and running here. The ability to do live changes while we go through these shows. Fantastic. All right, hopefully this pops in here when Bill joins us because now the room is open. I know he can't be here. I can see his microphone was not popping, so let me hopefully get him all logged in here. Give me just a second. That was weird. For some reason, when I pulled my headphones, it disconnected all audio. So we should have that stretched out. So to go back to that graphic here while I wait for Bill to jump into the link, it's fascinating to me that you have somebody, an entity, not a country, but an entity like Tether, all of a sudden being such a huge buyer of treasuries. And keep in mind, once we get this legislation, there'll be a lot more. There's going to be Tether. There's going to be USDC. There is talk that I'm hearing about World Liberty Financial possibly having one as well to, create their own stable coin. And that would also, if those rules are in place by our government that they have to buy treasuries, all of a sudden you see a lot more buying going in. Bill, you there? No, I cannot. Yeah, no, it's me. It's 100% me. I know it's definitely me. Let me add an executable here. We'll go to see if I can do that, and it's not for some reason. I don't know why it all of a sudden kicked you out here, but I'm not giving up. I'm not giving up. I'm gonna go zoom. I'm gonna trash zoom, and I'm gonna add an executable, and we're gonna call that zoom. All right, try it again.
I'll talk.
There
I'll
you go.
keep talking. So
I don't
you
get
found
it.
me?
Yeah, you're back. You're back. Strange.
All right.
All right. My apologize. My apologies.
No. Never. So I think where we left was I was congratulating you. I was not aware that just how big this market is. I am worried down the line about, getting more demand for treasuries. And this was not a marketplace that I realized was going to be that active participant. So I thank you for this.
Yeah. Yeah. And I know, especially as someone who does as much as you do, in training, you always have to think about what dynamics could change another dynamic. So if a stablecoin legislation passes and all of a sudden, there's new rules for this new financial structured instrument that has guidelines and framework approved by regulators. Okay, well, how does that instrument now function? And if part of their mandate is they can only buy government-backed bonds, whether that's short-term treasuries or maybe longer-term, I can't imagine that they would go anything into 10 years or 30 years. But maybe they go into 6 months or 1 year or 2 years, absolutely maximum. You've now created buyers, and that should, in theory, push those yields down further because of the demand, which would be good for the economy.
Correct. The circle of life. You got it. That is correct. No, it's a part of the marketplace, in terms of buyers of treasuries. I hadn't even considered, nor have I heard anybody else mention it. So thank you.
We
you're
always
right on top of things.
Love sharing, the knowledge that be. If you want, your camera's not on, so if you want to turn your camera on, you can too.
Okay.
I'll bring you back up here. I have an oddball question, and this I think is definitely an oddball. Well, it was on, and there it is. We have talked about the Fed manipulating, controlling, that's probably a better way, the short end of the yield curve, right? So they can, the short end is theirs. That's their domain, but not really doing too much on the long end. They can slightly buy, printing money and buying some bonds or building a portfolio. Right. We have a Secretary of the Treasury who says, I want a weak dollar. I would like lower yields. And then you have President Trump demanding lower yields. What actions could the Treasury Department or the President implement that may have a direct impact on the yields for longer term maturities?
Great question. And the analogy would be, because we have experience with this, is Japan. Because Japan has always done yield curve manipulation. The Central Bank of Japan not just targets the short end like our central bank does, but they also, for most of the pandemic and 10 years prior to that, had a yield that they wanted the 10-year JGB, the 10-year Treasury, to yield.
Right.
So, but here again, nobody has the authority to say, well, a certain security must trade at this price, any more than they could say, I want Apple to trade at this price. It's subject to supply and demand. So if you're going to make that commitment that you want a treasury to yield something, you have to be willing to go into the marketplace and buy and sell it to do that, almost like an ETF, right? You're adjusting the quantity every day to make sure it's trading in the range you want to do it. So, but that means that the government is going to have to probably print up more money to buy the treasuries. Probably the Fed would have to have a commitment to a yield curve policy. It's not just enough that President Trump wants the yields to go down.
Right.
It's that it has to be made policy, if you will. All right, we're going to have the 10-year yield X amount, as the Bank of Japan did. But then you're going to have to spend huge amount of resources to maintain that commitment. That's when they were doing QE. They were printing up boatloads of money. So why not use some of that money to manipulate the 10-year yield?
Yeah.
So, and we also have a question as to whether that even worked or not. This severe question, whether did you really get anything out of doing long-term manipulation versus the traditional short-term? So, if we were willing to give the Fed lots of spending ability, let them go print up a lot more money, and there was a commitment to do that from a policy point of view, the central bank could do that, as Bank of Japan did. I don't see either of those happening. It's kind of more an academic discussion than a real discussion.
Right.
As for the government, I don't see the Treasury Department getting involved in that at all, because the Treasury Department is more worried about deficits. Last thing they're going to do is increase deficits by having to borrow more money to manipulate the 10-year yield.
Yeah. Yeah, I was just curious because,
Yeah.
you hear Trump being such a stickler for it, and I demand that yields go down. It's like, well, bud, that's not how the system works. But, could he have some sway on it? Could there be things that are done that ultimately manipulate that? I do have the 10-year chart up here for the viewers at home. We've been talking about how it's been looking really good, especially if you were someone looking to buy a home, because at one point we were up at 4.8%, almost 5%, and now we're drifting, 4.8%, and now you're at 4.24. To me, it does look like we have a shorter term downtrend going on, and long term, I can't help but to feel bullish on yields. I think we're going to go higher. But, the chart right now is telling us yields are getting lower. That will be good for the housing markets. That's good for capital expenditures and loans and borrowing. And that stimulates economic growth the lower that this goes. So seeing this chart like this is good for America at this point. And that's why Trump wants it lower. I understand that. But as Bill has pointed out many times. What's that?
What president wouldn't?
Yeah, I know. I was going to say, as Bill has pointed out many times, every president wants it. It's supply and demand dependent. So ultimately, it's all about supply and demand.
Any elected official, particularly going into an election, would like to see rates coming down. Just ask Jimmy Carter. He knows what happened when the other happened. But by the same token, we also have a president who's a real estate developer. He's lived a life of wanting lower yields. So, yeah. I mean, it was just such. I'm not trying to. It was a silly comment because it's so absurdly simple.
But he's good at
the elected official.
He's good at making absurd comments. It's fun. It's fun sometimes. You just go, that was an oddball comment.
Right. Yeah. Right. Exactly.
Let's focus on something that might not be as an oddball of a comment. So right now at this point, because the wagers between us, I think you owe me about a keg of beer somewhere. But
I think it's a keg. Yeah, somewhere like that. Right.
Right now, there's all this speculation about where we're going to be by the end of the year. Now, at the meeting yesterday, or on Wednesday, Jerome Powell said, it was yesterday, wasn't it? Time flies when you're having fun. Jerome Powell said the median expectation based off the dot plot is 3.9%. Well, we're currently at 4.5%, which means dropping about 60 basis points, which means looking at 2, possibly 3 rate cuts. What do you think?
I'm of the other camp. I am the perpetual bear. I'm worried about all this money. We just spent all this time talking about all this cash out there. I will admit the inflation numbers for the last, particularly PPI, as you mentioned, but in general, the inflation numbers are, although not at target, going in the right direction presently. I don't mean to get political. These tariffs, I think inflation is going to be a problem. Yeah. I think at the end of the year, we could actually have a hike before we have a cut.
Wow. Yeah. Interesting.
Yep.
I wasn't going to say a hike by the end of the year, but, if the doo-doo does hit the... And that's the thing. We talked about this, and these... I have the best audience in the world because they understand that you can't hang your hat on making an aggressive call in these markets today. You can't say, without a doubt we're crashing, or without a doubt we're soaring. It's like, I believe the data is going to point to this, but this is the most chaotic, wild, shooting from the hip administration change I've ever witnessed. And I'm not complaining. It is what it is, whether you like it or hate it. Again, it's irrelevant. It's opportunity out there. So, I didn't think about rate hikes this year. Now, I think that if we get rate hikes, then you're assuming inflation's going to be significantly higher.
Yes.
Like what kind of numbers? What would you be an expectation of inflation?
That's,
Now I'm really putting you on the spot.
Yeah, you really put me on the spot. Well, let's be frank. We hit a high of 9 during the pandemic. And, cut that in half for lack of a number, you're looking at 4.5%. I could see numbers starting to approach that if we get the scenario I'm looking for. I mean, inflation, I feel like an old man, and I guess I am. But I have witnessed firsthand how quickly inflation can rear its ugly head.
Yeah.
Go back to 1979 when we had a 19% inflation rate. 2 years before that, we were down at 4%.
Yeah.
But now granted, that was a period of price freezes and that experiment that didn't work. But inflation can be vicious. So, I think inflation at 4% by year end, I think is achievable. And I think obviously with that type of environment, the Fed's going to have no choice but to bring up the short end. I mean, that'll kill Powell's career. But, if it's necessary, it's necessary.
Yeah. I mean, you got to do what you got to do. But I don't, I mean, here, I'm trying to bring it up for us right here. It's, Unfortunately, it's going to flag me. I'm using an ad blocker. But, here is inflation chart all time. Unfortunately, this is a really wonky chart, guys, because this thing has got this ad blocker piece on here. You look at the number that Bill's mentioning. We had 7.3 back in 2020. I'll zoom in a little bit here. Obviously, I don't think we're going to get back to the 1980s levels. But, the trend is certainly over the intermediate term that we've had for the past, couple of years to the downside. Getting back up to 4.5%, I don't think would be that out of line. This is an older chart here, by the way, but I'm with you. I do think that we're going to see a little bit higher inflation. 4.5%, I think, would be one of those kind of pucker up moments. Like, this is not what we expected. I mean, I think even if you got to 4%, it does bring the discussion of, okay, we have to start raising rates here again. So interesting.
And I would point out, and I like the charts that have a longer context because I will readily agree that, people were worried and even making a political issue about it, that, last year before the Fed started cutting, we had a highest Fed funds rate in 20 years.
Yeah.
And, it was done with a certain amount of finger pointing usually.
Oh, it always is.
But I would point out, look at that 20-year period that we're talking about. If you had the Great Recession from 2008 through 2013, and then you had the pandemic during that. So here was 7 concerted years where our Fed was intentionally manipulating rates to lower to stimulate a bad economy. You had the Great Recession and the pandemic in that 20-year period. As your charts show, you give it any longer context, and suddenly that, 5.25 where we were didn't look so outlandish with a longer scope.
Yeah. Well, time will tell. Ultimately, it's going to come down to what these markets hold. And again, I'm with you. I do think inflation is going to rear its ugly head, but I've actually read some stuff by economists that think that it actually could be very deflationary with regards to prices. So, who knows which way this darn thing is going to go. Real quickly, I have my takes on this, but I'm curious what your perspective is. Luis says, how long does it take for rate cuts to reflect in the market basket?
That's a great question, Luis. That's a great question. And traditionally, it's assumed to be about 6 months. That, from the time the Fed reverses direction, because those are the most significant changes, and we can kind of measure them easier. So, from the time the Fed changes rates, that one-day interest rate, to the time that works its way through the economy to any measurable extent is considered to be 6 months. Which is why when Powell is saying what we do today, we don't know what the impact is going to be. So, I'm not trying to cut the Fed too much slack, but I do think they have a reason for saying we need to be data determined. Controlling the economy just by changing the overnight rate that banks borrow and lend money, kind of like washing an elephant with a toothbrush. It's just an endless task.
Yeah.
No, great question. 6 months though.
Yeah, it's interesting because my mentor, when I started, when he was just a trader, he wasn't a bond guy, but he as a trader, he would say, 6 to 9 months, sometimes getting into, a year cycle. And I think it's funny because, when you have these rate announcements, the cuts are held or raised or whatever, the market has these amazing surges. These knee-jerk reactions are like, all right, here we go. The world is different today. It's like, actually, no. This takes months and months and months to filter through to the bottom line, to your financial statements and economic data. So this is why it's so difficult. You can't aggressively raise rates back to back and expect to understand what the reaction is going to be. Which is why I actually really am impressed with what's happening right now. I did not think we should have cut those rate cuts we had last year. I do like that we're holding. I like that we're holding right where we were at.
Yeah. No, I think the market feels comfortable with that. But, when you ask for prognostications, I will be the first to admit I'm a 40-year bond guy. I look at the equity market and I just don't understand it. And yesterday is a perfect example. The Fed is saying GDP is going to go from 2.1 down to 1.7. Inflation is going to tick up moderately. Mm-hmm. There was nothing good news in the announcements other than, rates were going to change, which we knew was going to happen anyway. And yet, the equity market rallied by 1% yesterday on a declining GDP, rising inflation, and rising unemployment. I just don't understand the equity market. I'll be the first to admit.
Bill, Powell said that next year inflation is going to be 2.2%. Come on, right. You've got a list to look forward to because clearly he has an indicator that tells him what it's going to be like in 2 years.
I missed that. You're right. My bad.
There, wow. Where's your optimism, buddy? Well, just to make you feel good, I'm going to go over here to the CME Fed Funds Futures forecast, which is where people, what the Fed Funds Futures are saying. Not one person, not one, is saying that we're going to see rates move up. So Bill is the outlier on this bell curve you have here. Right now, 32.6% chance of 3 rate cuts by the end of the year. You have 28% chance of 2 rate cuts and a 19% chance of 4 rate cuts. That's the bulk of the curve right there. But again, it's all over the place. And, one thing for the viewers out there, if you think that the Fed right now, the markets are pricing in 2 to 3 rate cuts, which would stimulate the economy. If Bill's right, and we get a rate increase, then think about what that might do to these markets. These markets are going to start to trend down in an aggressive way because the bread basket's not there anymore. Yeah.
By the way, I would point out that same marketplace that is forecasting 3 rate cuts for 2025, the futures market, isn't that the same market that was forecasting 8 rate cuts in 2024, as I remember?
Yep.
Remember
Absolutely.
when we hit that?
We were laughing
8 cuts
so
we were going to get.
8 cuts, yeah. I think every time I see a trades like this or some indicator, I'm always saying that's the rose-colored view. Or those are the rose-colored glasses view. Like, okay, when the dot plot said we're going to have inflation at 2.7 this year, maybe we'll call that 3.25. They're way low on their expectations generally. So
yes, I would agree with that. Absolutely.
As a bond guy and markets, are you a gold guy as well?
Much to my surprise, I find myself being so, and I have been for about the last 7 years. Yes. I'm not a huge gold bug, but I surprisingly feel I find that there is a place in portfolios for it these days.
Yeah. So what's your take on it from a portfolio perspective? So Margaret asked, please comment on gold. So I guess any commentary you want to give on gold, because I'll give my thoughts here in a second.
Gold traditionally, as we know, is the flight to quality.
Yeah.
And if my scenario, and I admit I'm very bearish, if my scenario is right of rising inflation, tariff issues, trade wars, gold is that traditional haven to safety that you want to see. It's just that simple. So I do feel, maybe it's my own growing paranoia, that for safety reasons, I want to have gold in my portfolio.
Yeah, I agree.
It's the traditional flight to safety. Has always served that purpose, and we get distracted by the Bitcoin discussion as to whether that is a flight to safety, and maybe over time it will. But right now, until it's more proven, I feel very comfortable sticking with gold.
Yeah, absolutely. And I think that you should have an allocation to both. I think that there is some merit, especially now we have such a regime change with regards to digital assets. But the time will tell what ultimately filters out from that. And is it Bitcoin or Ethereum or Solana or something else? Who knows? It's just still such a new world for us to explore. But yeah, I think you go physical gold, digital gold. Why not have a little bit of each one in your portfolio?
Yeah, and honestly, I'm going to be a commercial for ETFs. Why even hold the physical any longer? The ETFs, you can day trade it. You can do option strategies. I love the gold ETFs.
I like them too, but I like holding gold. I have my gold coins. I just bought 2 10-ounce silver bar. I do. I feel like Gollum. My precious. My precious. It's just kind of surprising how heavy gold is, by the way, when you have like a gold bar. I like having physical gold, physical metals. The challenge is the spreads and the markup, and all that. It's just, it's a nightmare.
You know the price you're paying for that emotional response.
Totally. And I definitely paid a premium for these silver bars, but it's okay. I know that probably over the next 10, 20, 30 years, those will be significantly higher, and I'll just hold on to them, or I'll just die with them and hope that people can find where I put them. Tell me about your upcoming class schedule. Are you teaching any canary in the coal mine stuff, XLTs? What you got cooking?
Do. Talk about timing. Tomorrow.
Oh, wow.
Tomorrow's our next focus class where we do the 1-day fixed income canary in the coal mine, where we kind of try and address the 2 constituents that we have now for the bond market. The one is the traditional income buyer, the coupon clipper. And this market now, with interest rates being where they are, there are some attractive yields out there. We talk about mortgage yields now. With mortgage rates still over 7%, you can get 6.25% government guaranteed on mortgage paper. So we're going to talk about the income opportunities, even the Treasury ladder right now. The fact that 1-month T-bill is still such high yielding relative to the rest of the curve, there's those opportunities. So we try and appeal to the income student, but there's also the trading student. This gets us into the ETF discussion.
Yeah.
My background as a trader, I love trading the market, but for retail investors, I really believe ETFs are the way to go. So we get into the trading side, and certainly you focus on it every time. The volatility that we're seeing these days, it's nothing to get 10 basis point whipsaw intraday. This is a trader's market as well. So we've got two constituents there, and we also try and work in the whole reason that, and I got to give Merlin credit, he actually named this class the canary in the coal mine, because the
I didn't
interest
mean
rate
to.
market, well, I know, but you were brilliant and you didn't even realize it. But the interest rate environment affects almost every other asset category. Just as we're having in this discussion today. So when we talk about the Fed is raising and lowering rates, what does that actually mean? What rates are we doing? What's the impact of the dollar? What's the impact to other markets? Because we have that contango, that correlation between the different asset categories. So if you're trading almost anything, I think you're really remiss if you don't know what's going on in the interest rate, central bank, Fed, and world.
Yeah. I will say
so that's what we'll be doing tomorrow.
I've had more of an interest, and it's funny because not only have I a much greater interest in bonds, and personally, I'm not at an age where I'm worried about income streams from the bonds, but I now benchmark a lot of my investment decisions on, well, if I could just buy the bond and get X percentage, do I want to make this other investment choice? So it's a nice little benchmark, but also knowing that, especially if you need a certain amount of rate of return during your golden years, or at least get an income stream, bonds are such a great thing for that. So I appreciate that you opened my eyes to the world of bonds and come on here with regularity to share your knowledge. We love it.
I enjoy it. You and your audience are great. I enjoy all the time I spend with OTA. We're going to have a good time tomorrow.
Good. Well, if you guys want more information, you can actually go to, I think if you just go to the internet and type in Trading Academy Focus Courses, there's a page that has all of them. You can also find out more information at aftraining.co. That's Bill's page there, and he's got all kinds of videos. He's got a book set there as well that's got a clearance price on them for all three of them. You guys can check that one out. So, Bill, again, thank you so much. I appreciate every time you come on. Too bad you're not coming out to the West Coast anytime soon, but when you do, I'm going to lock you down and we'll get some beer redemption.
There's some beers ahead. I look forward to it.
Sounds
Absolutely
good.
Look forward to it.
All
right, guys. Have a great weekend. Have a great holiday. Have a great weekend.
All right, take care.
Bye, guys.
Guys, that was Bill Addiss joining us from the East Coast today, where he is, unfortunately, my little technical problem cut out for a few minutes. But we did manage to bring him back to get a full show with Bill Addiss and get his views on all things interest rates related. So, hope you enjoyed that one. And again, sorry for the tech difficulties. Had to deal with it all live on the air. I managed to do it without maybe a minute or two of lost time. All right, let me run through our markets here. I just want to make sure I get through this stuff quick because I'm running out of time, and I want to make sure that I get the markets covered because we didn't really talk too much about them yesterday. Today we had a little bit of a down move, a disappointing speech, in my opinion, from President Trump. And it wasn't disappointing. He just said everything he's already said. There was nothing new that came out of his presentation or his talk today at the Digital Assets Conference. Basically talked about stablecoins, the importance of stablecoins. He talked about a little bit about the strategic Bitcoin reserve, but nothing there was groundbreaking. I think a lot of people really were expecting other pieces. So I think that's what caused Bitcoin's bit of a sell-off today. It's down 1.68% on the futures market, but still within this nice little channel here. Like it, in the channel. Good, channel's good. Russell 2000. You had a 0.68% slide for the Russell today, but again, knee-jerk reaction. I think, Oliver, you had mentioned someone the other yesterday, I think about a bear flag or a bull flag. You look at what's going on with the Russell, I would argue that this is more of a bear flag because you have a really aggressive sell-off over a short window of time followed by a retracement channel. So from that perspective, the Russell is actually pulled back into a drop-based drop, and that may act as a bearish flag formation. If that does happen, that means more downside move here ahead for the Russell, but just wanted to get a little bit of clarification. There you go, Margaret. Yep, the bear flag on this one. NASDAQ down 0.36%, same thing. Aggressive sell-off, mild retracement. So to me, both of these could have bear flags. With regards to Bitcoin, I don't see this sell-off being as steep, right? Notice that I'll keep the Bitcoin chart up here. So that line angle looks like that. If I go to the NASDAQ, to me, much steeper. Russell, much steeper from this point here. It's really the magnitude of the sell-off. I don't personally think that sell-off in Bitcoin is a pull. So remember, the flag formation is a pull and then a retracement from that, a slight retracement. Ideally, when you have a big pull or a large move up in price action, it's called a high-tight flag, which price doesn't fall at all. That's a really bullish sign, and you can flip that upside down for a bear flag. So I don't see a pull, if you will, on the Bitcoin chart. It looks more like a pull here for the NASDAQ, for the Russell, and you could argue for the S&P as well, right? So to me, and again, that's my perception of it. For Margaret, Oliver, that's my perception, is this would look like a pull. That S&P, just really aggressive. I did open up short positions on S&P. I went and bought puts. I bought I got to test my memory here. I bought the July 18th 510 puts for the S&P on SPY. I was going to do XPX, but I decided just to do SPY. No real reason why, but yeah, I started there. I didn't go huge position, but definitely has some size to it, and we'll see what happens over the next couple of days. I may add some more to this, but I'm just not sure if this supply level that we've been bouncing out of is going to hold. If it does hold, I'll start adding more and more, particularly if we break back below the 5509, I'll start piling into it more and more, but did start building a short position today. I think, Margaret, you've been asking me when I'm going to start. I started today. So there we go. 10-year yield, we already looked at this one. Interesting chart, by the way. It has that long bottoming tail that went right into that zone that's attacked a few times, just below 4.18%. Closed at 4.24%, but it's that trend. Lower lows, lower highs look like they still are in play here. So to me, that's the direction of this one, which means potentially long opportunities for bond ETFs like TLT and SHY and things like that. Top podium, gold. Only up 0.09%. Again, I am very bullish on gold long term. Very bullish on gold long term. I'm bearish short term. I think that right now, the next few days, you'll see a little bit of a retracement here in markets overall, as well as commodities. I think it's going to be that kind of overpriced market, getting a little bit of a sell-off here. Now, we had that shooting star on yesterday's candle on Wednesdays. Did not get an entry point today. Again, if we get below 3,031, that's the low point. Today we hit 3,032. So got so close to an entry point there. If we get that, I think you have a short opportunity here for gold. We'll see if that one comes through for tomorrow. Now, the dollar index had a slight increase, but again, I feel it's just floundering and flat right now. So nothing really exciting about that dollar index. And crude oil got a nice bounce today, but still not out of the woods, right? It had a great 1.73% move to the upside, but there is no new high being made. It hasn't, broken above any level that really is of importance. It's still stuck kind of near that bottom end of the range, which still makes me nervous. And again, long term, I'm bearish on crude oil. Now, there was a comment earlier about doesn't the weaker dollar, which the Secretary of the Treasury says that he wants, doesn't the weaker dollar help gold prices? Yes, and I think that that's part of why you're seeing gold surge. I also think that the reason that we're seeing gold surge is I think the smart money is moving into gold knowing that, or at least anticipating, that the market is not as stable as some may assume. It feels strong, it feels good right now, but that uncertainty and mounting uncertainty could cause bigger problems. I was really surprised to hear Bill say he thinks maybe a rate increase this year. That would be a shocker if that did come through. I might erase some of his beer debt for that one if he calls that one out correctly. So there we go. So that is it for your your top 8. Let me run through your Forex factory economic calendar for mañana. For today, by the way, we can look at Thursday's activity. We had crude oil inventories, which were much higher than expected, and I'm really surprised that we saw the price of oil jump like that. Typically, when you have a surge, it goes the opposite direction. But what else did I have on there that was noteworthy? No, that was it. So let's go for Friday. It's Friday. I'm loving it. Tomorrow's a big day from the services and manufacturing numbers. You have services and manufacturing numbers coming out for France, Germany, the EU, the UK, and the United States. We also have existing home sales. So this is old hat here. Hold on a second. That's bizarre. Look at this chart. This is really interesting. Oh, I'm on February. There we go. It's the same thing. Oh, maybe I was wrong. I thought I had it wrong. Never mind. Sorry. My bad. We'll check that earnings beat in just a second. So I was completely wrong with that one. My bad. Let's strike that from the record, Your Honor. I could have sworn we would have that same calendar here. So we only have retail sales, which was earlier this week. And for the U.S., we have nothing. So, talk about boring. I had scrolled back on the calendar here, so there we go. Those two rate announcements, by the way, came in line with what expectations. We had the Swiss National Bank cut 25 basis points, which was the expectation, and the British pound stayed right where it's at. So no services numbers tomorrow. I don't really pay too much attention to the triple witching, quadruple witching, and all that type of stuff. I don't know. I haven't. It hasn't impacted me much. Big Eb says, any thoughts about the triple witching tomorrow? 4.5 trillion options expiring? Not really. I don't really have any thoughts on that one, Big Eb. Not something I focus on. I used to in the past, and I really feel like it never really impacted me, and I just never did. Last one. It's funny. There's a guy named Jeff Mackey. Jeff Mackey used to work for Yahoo Finance, and I actually like his style. He's a good guy. I've actually reached out to him, asked if he wants to come on the show, but he's never responded to me, of course. So One of his things was talking about Nike. I'm bullish on Nike, and they came out with earnings today. Luckily, I didn't buy calls. I was going to buy outright calls today on Nike, expecting them to have a nice big pop to the upside. Thank goodness I did not do that. We're down 4.7% in the after-hour session here. I'll bring up the 5-minute time frame so you guys can see that one. But yeah, I was just about to go and buy a bunch of call options on Nike for the next month or two. Probably go up more like 3 months because I like to buy more time. Glad I didn't, because I'd be underwater right now. We'll see what happens tomorrow, and certainly I want to look into what happened on that announcement. Why did it surge up a good portion and then all of a sudden come screaming back the other way? Clearly something was said that they did not like at all. So there's your bigger earnings. There were a couple others that reported earnings today, but I just have been so busy I haven't had a chance to check those ones out. All right, and as far as earnings for tomorrow, typically Fridays, as you know, is just kind of a dead day. There's not a lot going on, but I will bring up an earnings calendar here so we can check out that just to make sure. Fridays usually crickets, but may not be crickets tomorrow. I do believe there's 2 names that I remembered. Yeah, we have NEO. So NEO, here's the companies reported today. So you had FedEx report, they're getting crushed, down 5%. You had Nike down 4.3%. Lennar was down 3.3%. Oosh, ouch. And the only one that missed on earnings was FedEx, and it was everything else was down. So let's go to Friday and pop it up here. Hopefully it populates soon, because something clearly is just slow. I'm not sure why it's taking so long to get my calendar for Friday up, but I don't remember anything really that significant. I thought it was an EV company. I know we had NEO report. It is tomorrow. So BMO tomorrow. You're gonna have NEO. You have Carnival. And other than that, I don't see anything in here that's that big of a major U.S. name. So there you go. Quiet day. All right, everybody, that's going to do it for me. Hope you enjoyed Bill Addiss. Again, if you want to find out more information about his class, you can go to Trading Academy and contact anybody there, or you can just go to Google and type in Trading Academy, search for focus courses, and you'll see a whole list of the focus courses, including my crypto course there. But there we go. Neo's my dog's name. Oh, nice. Neo, I'm going to just say it all the time now. It's NEO, and the stock is NIO. All right, everybody, thank you so much. Hope you enjoyed it, and appreciate the patience today with the little tech issue that was caused by me pulling on my mic cable over here. So at least we got it finished so we could get Bill to join us here at the end. So thank you guys so much. I do have some questions I need to answer from some of you viewers that have sent those in. I'll do a bunch of Q&A tomorrow and catch up on my my email box. So if you got something you want on tomorrow's show, email me, tradermerlin@gmail.com. See you guys tomorrow. Take care.